Have you ever wondered why silver prices never seem to reflect the real demand? Something strange is happening behind the scenes, and most people don't even realize it. Right now, banks might be quietly controlling silver prices, and it's happening in ways that could shock you. Stay with me, because what I'm about to reveal could change the way you think about the silver market forever. Before we dive deeper, take a moment to hit that like button. And don't forget to subscribe to the Gray Ledger for more insights you won't hear anywhere else. It all starts with supply and demand, or at least what we're told is supply and demand. Physical silver is scarce, yet prices remain strangely stagnant. Why is that? The answer lies in something most people never hear about: market manipulation. For decades, powerful banks have been quietly influencing silver prices. They do it through paper markets, futures contracts, and derivatives. To understand this, we need to go back to the basics of how silver trading works. There are two main markets for silver: physical silver, which you can hold in your hand, and paper silver, which exists mostly as contracts. Paper silver makes up the majority of all silver traded globally. For every ounce of physical silver, there are hundreds of paper contracts floating around. This imbalance gives banks immense power to push prices down or hold them back, almost at will. You might be asking, why would they do this? The answer is simple: profit and control. Banks benefit when silver prices stay artificially low because it allows them to acquire physical silver at bargain prices. Every time silver tries to rise, massive sell orders hit the market. These sell orders often come from institutional players who are connected to major banks. It's almost like an invisible hand constantly pushing silver back down. The Gray Ledger has been following this story for years, and the evidence is growing, showing a pattern of price suppression that isn't random at all. But it's not just about profit. By controlling silver prices, these banks are also protecting the value of other financial assets. If silver prices were allowed to surge, it could expose weaknesses in the global financial system. Think about it. Silver has been a store of wealth for thousands of years. It's a hedge against inflation, a safeguard during crises. If banks lose control of silver, everything else could start to unravel. And here's something many people don't realize. During major market shocks, like the 2008 financial crisis, silver was targeted directly. Prices were hammered down even as demand surged. This wasn't luck. It was a coordinated effort to protect the interests of a few at the expense of the many. But how do they actually do it? The key tool is the COMEX futures market. Banks and large institutions can buy or sell huge quantities of paper silver contracts, influencing prices in seconds. Even small traders think they are moving the market sometimes, but they are only reacting to the larger forces at play. The real movers operate quietly and invisibly. Another tactic is something called naked shorting. This is when more silver is sold than actually exists. It's like promising something you don't own and using it to manipulate the market. And the crazy part? This is perfectly legal, or at least mostly unregulated. Banks exploit loopholes and gaps in oversight to maintain control. You might think, well, that sounds like conspiracy theory stuff, but the data is there, clear as day. Every major silver rally in the past decade has been met with sudden, unexplained drops. And not just small drops, massive, market-moving crashes. These are often timed with economic events, government announcements, or geopolitical tension. It's almost like silver has an invisible ceiling. Every time it tries to break out, someone is there to slam it down. The Gray Ledger has tracked these events closely. Patterns emerge that are too consistent to be coincidence. Even insiders have spoken out. Traders, analysts, and even whistleblowers have confirmed that silver markets are manipulated. But they are careful. Most of them remain anonymous because speaking out can cost careers and even freedom. And this manipulation doesn't just hurt investors. It affects anyone who holds silver, even indirectly, like ETFs or retirement accounts. It keeps wealth concentrated in the hands of a few, while average people watch from the sidelines. The manipulation is subtle, almost surgical. It's not about crashing the market completely. It's about controlling the pace, keeping silver just low enough to serve their interests. And the scary part? They can do it at any time. All it takes is a coordinated push in the futures market, and prices can move drastically in minutes. Even when global demand spikes, prices barely react. The disconnect between real-world supply and market price is staggering. But why now? Why talk about this today? Because the silver market is at a tipping point. Physical silver is running out. Mints are struggling to meet demand. And yet, paper silver keeps multiplying. This creates a powder keg situation. If banks lose control, prices could explode. And when that happens, it will happen fast. Many analysts believe we are only months, or even weeks, away from a major silver shakeup. And the question is, who will benefit and who will lose? Before we go deeper into what could happen next, make sure to like this video. Subscribe to the Gray Ledger so you don't miss any updates on this unfolding story. The evidence of manipulation is everywhere if you know where to look. Price charts show patterns that can't be explained by normal supply and demand. Every attempted rally is met with resistance that appears almost magically. To really understand what's happening, we have to look at history. Silver manipulation isn't new. It has been happening for decades. In the 1980s, for example, there was a famous attempt by two traders to corner the silver market. Their names were Hunt brothers, and they almost succeeded. They bought massive amounts of physical silver, pushing prices from around $6 per ounce to over $50 in just a few years. It seemed like they were unstoppable, until the market fought back. Banks and regulators stepped in and prices crashed almost overnight. The Hunt brothers lost billions, but the event showed how fragile the silver market really is. Since then, powerful institutions learned the lesson. Control the market quietly or risk chaos. Instead of letting anyone corner silver, they became the cornerers themselves. Today, the same tactics are used, but on a much larger scale. The COMEX, LBMA, and other trading platforms allow banks to move paper silver in ways ordinary investors can't even imagine. They use high-frequency trading algorithms to react faster than any human. These programs can sell millions of dollars in silver contracts in seconds, pushing prices down before anyone even notices. And there's another layer most people don't see: derivatives. Banks create complex contracts that bet on the future price of silver without ever holding the metal. These derivatives give them enormous influence over the market. It's almost like a hidden lever controlling silver behind the scenes. When they pull it, prices move and the rest of the world reacts without understanding why. One of the clearest examples came in 2011. Silver was skyrocketing, hitting nearly $50 per ounce. Investors were thrilled, thinking a new bull market had begun. Then, in a matter of months, the price collapsed to under $30. What caused it? Massive paper silver sell-offs coordinated by major institutions, all executed through futures and derivatives. And this isn't speculation, it's documented. Reports from analysts, leaked documents, and government filings show a consistent pattern. Every rally is met with aggressive interventions. The Gray Ledger has tracked these events carefully. We've noticed that silver behaves almost like a controlled asset. It moves when banks want it to, and it stalls when they decide it's time to stall. Another tactic is spreading doubt. Whenever silver starts to rise, media outlets and financial commentators emphasize potential risks, often exaggerating them. This makes ordinary investors hesitate or sell, giving banks more control. It's subtle, but it works. Fear and uncertainty are powerful tools. They keep retail investors on the sidelines while the big players make their moves. Now let's talk about gold, because it's closely connected to silver. Gold is easier to manipulate because it's larger and more liquid, but silver reacts even faster. Banks use gold as a reference to manage silver prices, often pushing silver down whenever gold rises. Some analysts call it the gold-silver leash. Silver can't run too far ahead of gold or the system starts to show cracks. And this leash is not just theoretical, it's actively enforced in the market. Every time silver threatens to break free, massive interventions bring it back in line. But why does this matter to you? Because silver isn't just another commodity. It's a financial barometer, a store of value, and in many ways, a hidden insurance policy against economic turmoil. When silver is suppressed, it keeps ordinary people from protecting their wealth. It keeps banks in control of the system, while the majority watch their opportunities slip away. Even central banks get involved. They hold enormous silver reserves, but they don't always report them publicly. By controlling both physical and paper silver, they can influence markets without anyone noticing. And let's not forget about ETFs. Many investors think buying silver through ETFs is safe, but these funds often hold mostly paper contracts. That means their value is subject to the same manipulation as futures markets. It's a hidden trap for retail investors who think they're buying silver, but are actually caught in a complex web of control. And while all this is happening, demand for physical silver is rising. Mints are running out of coins. Jewelers are struggling to secure supply. Industrial demand is climbing as well. The gap between real-world demand and market price is growing wider every day. It's almost like a pressure cooker waiting to blow. And when that happens, ordinary investors could be caught by surprise. Prices could spike rapidly, leaving those who didn't secure physical silver out in the cold. The Gray Ledger has been warning about this for years. We've seen the patterns, tracked the anomalies, and studied the interventions. And the evidence points in one clear direction. The silver market is being quietly controlled right now. This isn't a distant theory, it's happening as we speak. Every day, trades are executed to maintain control, to suppress rallies, and to protect the interests of a few. Even small price movements are carefully monitored. Banks know that even a minor surge can trigger a chain reaction in the market, and the tools they use are evolving. High-frequency trading, derivatives, algorithms, and coordinated strategies make manipulation faster and more precise than ever. But the story doesn't end there. There's another dimension that most people completely overlook: geopolitical tension. Events like trade wars, sanctions, and military conflicts influence silver demand, and the response is often engineered. Banks use these events to justify interventions, making it look like market forces are natural. In reality, it's a controlled narrative designed to keep prices in check. This creates a cycle that's almost impossible to break. The more silver is suppressed, the more it attracts attention. The more attention it attracts, the more banks intervene. And yet, despite all this, silver still finds ways to signal stress in the financial system. When silver acts up, it's often the first warning of economic turmoil. That's why the Gray Ledger believes silver is the canary in the financial coal mine. Understanding what's happening in this market can give you a huge advantage. But it requires paying attention to more than just price charts. You have to understand the signals, the patterns, and the players behind the curtain. And for those who do, the opportunities could be significant. But only if you act wisely and with awareness of the risks involved. Right now, the silver market is sending signals that can't be ignored. Physical demand is surging while paper silver keeps multiplying, creating an enormous imbalance. If you pay attention to the charts, you'll notice unusual patterns. Every small rally is quickly met with resistance, as if an invisible hand is holding silver down. The Gray Ledger has tracked these moves for months. The patterns are consistent, precise, and almost surgical. One of the clearest indicators is the ratio between gold and silver. Historically, it has averaged around 60 to 1, but today it's spiked to levels that suggest silver is undervalued relative to gold. This isn't just a coincidence. When silver is artificially suppressed, the gold-silver ratio skyrockets, signaling market manipulation. Another key signal comes from futures positioning. Large institutional players often hold massive short positions in silver, betting it will fall. These positions are visible in regulatory filings, and they often peak right before price drops. And it's not just speculation. These movements can move millions of ounces of paper silver in seconds, impacting prices globally. Even retail investors are starting to notice. Coin shortages, rising premiums, and delayed deliveries are all warning signs. Physical silver is simply running out in the real world. Mints like the US Mint and private bullion dealers report unprecedented demand. Some products sell out almost immediately, and premiums over spot prices are climbing. Yet, despite this real-world demand, market prices barely budge. This is the clearest sign that someone is controlling the market behind the scenes. Banks and large institutions have both the resources and the incentives to do this. By suppressing silver prices, they can accumulate physical silver at lower costs. It's a massive wealth transfer from the many to the few. But the manipulation isn't always about buying cheap silver. It's also about maintaining confidence in the financial system. If silver were allowed to spike too high, it could expose vulnerabilities in currencies, debt, and derivatives. That's why interventions are timed so carefully. Whenever geopolitical tension rises or inflation spikes, silver often remains muted. The market looks natural on the surface, but the reality is engineered. Even unexpected events like strikes at major mines or sudden changes in industrial demand rarely move prices the way they should. Banks step in almost instantly to counteract any upward pressure. Another way they control prices is through regulatory influence. Rules, margin requirements, and trading halts can be adjusted subtly to influence market behavior. Most investors never realize how these decisions affect prices in real time. And then there's manipulation via the media. Analysts, commentators, and even financial news outlets often highlight risks, underplaying opportunities. This creates hesitation among retail investors, giving banks even more control. Despite all this, silver remains one of the most important metals in the world. It's used in electronics, solar panels, medical devices, and countless other industries. Demand is not slowing down, it's accelerating. This creates a ticking clock for the market. The longer silver is suppressed, the more intense the eventual breakout will be. And when it happens, it could be fast, dramatic, and potentially market-changing. The Gray Ledger has been monitoring this closely. We've seen that spikes in physical demand often precede major price movements. Coin shortages, industrial buy-ins, and ETF flows are early warning signs. For ordinary investors, this is both a risk and an opportunity. Understanding the signs and acting wisely can make a huge difference in protecting and growing wealth. It's also a reminder that the system isn't always fair. Banks, institutions, and even central banks hold enormous power over the silver market. Most investors are simply watching from the sidelines, and that's why education is so important. Knowing what's happening behind the scenes allows you to make informed decisions, rather than reacting blindly to market moves. So, what should you watch right now? First, monitor physical supply closely. If mints run out of silver coins or premiums rise, it's a strong indicator that demand is exceeding supply. Second, watch futures markets. Large short positions by institutions often signal potential manipulation. If these positions suddenly unwind, silver could surge unexpectedly. Third, pay attention to global events. Economic crises, inflation spikes, and geopolitical tensions often trigger hidden interventions. Understanding the timing of these events can provide insight into market behavior. Fourth, observe ETFs and other silver-backed funds. Many of these funds hold paper silver, meaning their prices are tied to the same manipulations we've been discussing. And finally, trust your research. Cross-reference multiple sources, track anomalies, and watch for patterns that repeat over time. The gray ledger is committed to providing insights like this to help investors navigate these complex dynamics. It's also important to remember that silver manipulation isn't about guessing, it's about evidence. Charts, reports, filings, and physical supply data all point to an ongoing effort to control prices. The question is no longer whether manipulation exists. It's how long it will continue, and what will happen when the system reaches its limits. And this brings us to the most critical point, the potential for a silver explosion. When the market can no longer be suppressed, prices could rise rapidly. The event could be triggered by a shortage, a geopolitical crisis, or a sudden unwind of massive short positions. For anyone holding physical silver, this could be a life-changing moment. For those relying on paper silver, it could be a shock. And for banks, it's a calculated risk. They know the system can only be suppressed for so long. That's why paying attention now is crucial. Understanding these dynamics, patterns, and signals could make the difference between being prepared or being caught off guard. As we reach the final part of this story, one question remains. How long can this system really last before it breaks? History tells us that no manipulated market survives forever. Eventually, reality catches up, and the truth comes out. The silver market is no different. Every ounce of paper silver represents a promise, and every promise has a limit. Right now, there are far more promises than real silver. That imbalance keeps growing day after day, month after month. At some point, investors will demand delivery. They will want the physical metal, not contracts, not numbers on a screen. And when that happens, the system will be tested like never before. Imagine thousands of investors asking for real silver at the same time. Imagine warehouses running low. Imagine delivery delays becoming normal. That's when confidence starts to crack. And when confidence disappears, markets change overnight. The gray ledger believes we are moving closer to that moment, not tomorrow, not next week, but steadily, quietly, inevitably. We've already seen small warning signs, shipping delays, rising premiums, limited availability. These are not accidents, they are symptoms of stress beneath the surface. If the pressure keeps building, something will have to give. Either prices will rise sharply, or the paper system will collapse, or both. Some analysts believe silver could double or triple in a short period. Others think it could go even higher. No one knows the exact number. What we do know is this. When suppression ends, it usually ends violently. We've seen it before in other markets: housing, tech stocks, cryptocurrency, energy. Each time, prices stayed controlled for years. Then suddenly, everything changed. Silver has all the ingredients for a similar move. Limited supply, rising demand, heavy manipulation, and growing awareness. More people are waking up. More investors are questioning the system. More buyers are choosing physical silver over paper promises. That awareness is powerful. It weakens manipulation. It strengthens real demand. And once awareness reaches a tipping point, control becomes impossible. This is why understanding silver matters. It's not just about making money, it's about protecting your future. Inflation is rising, debt is growing, currencies are being printed at record levels. Trust in institutions is fading. In times like these, hard assets matter. Real assets. Assets you can hold. Silver has survived empires, wars, and financial collapses. It has always returned as a store of value. And today, it may be preparing for another chapter. That doesn't mean everyone should rush in blindly. Smart investing is about patience, research, and discipline. It's about understanding risks as well as opportunities. But it does mean staying informed. It means asking questions. It means not accepting surface-level explanations. That's what the gray ledger is all about. Looking deeper, connecting the dots, sharing what others won't. If you've watched this far, you're already ahead of most people. You're taking the time to understand how the system really works, and that matters. Now I want to hear from you. Do you think silver is being manipulated right now? Have you noticed strange price movements or shortages where you live? Leave a comment below and share your thoughts. Your perspective could help others see what's really happening. And if you found this video valuable, please share it with someone who needs to hear this message. The more people understand the truth, the harder it becomes to hide. This conversation doesn't end here. It grows with every voice that joins in. So comment, share, and stay connected. Because the silver story is still being written and the next chapter could change everything. Thank you for watching. This is the Gray Ledger, and we'll see you in the next one.